The rupee just printed a new reality, and metals are about to price it in faster than most people can emotionally handle. Not because the world suddenly discovered India, not because a pundit said the word crisis on TV, but because the currency move forces real participants to do real things with real invoices. And when that starts cascading, the paper narrative loses control. And if you stay with me, I am going to give you the one hidden metric that matters more than the headline, gold price, the calendar trigger, that's quietly amplifying this move right now, and the levels and signals to watch over the next week or two. So you're not guessing in the dark. Here's the tension. People keep saying the dollar is strong, but that's not even the cleanest way to understand what's happening. Because the dollar can look soft in one global measure and still crush a local currency like the rupee if the local plumbing is under pressure. That sounds abstract, but it's the difference between watching a global scoreboard and watching the game you're actually in. And that's where the real pressure starts. When the rupee weakens sharply, metals don't behave like a normal asset class. They turn into a translation machine, a multiplier. Gold and silver aren't just prices on a screen. For a country that imports a huge portion of its precious metals supply, they're effectively a currency hedge that shows up in your face at the jewelry counter in industrial procurement budgets and in futures margin calls. That's the uncomfortable part. The move is not philosophical, it's mechanical. Let's get something straight, fast. You can have gold barely moving in dollar terms on a given day and still see gold explode in rupee terms. Same bar, same metal, totally different reality. That disconnect makes people feel like they're going crazy, and that emotional confusion is exactly how the market gets away with shaking you out at the wrong time. But that's not the part that matters. The part that matters is who gets forced to act. Importers, jewelers, manufacturers who need silver and copper and aluminum and specialty metals on a schedule, banks that provide hedges, funds that run risk limits. When the rupee slides, the cost of replacing inventory jumps, the cost of hedging jumps, the margin requirements jump, and suddenly, people who weren't trying to buy anything become buyers because their job is to not blow up. That's the setup. And if you miss that, you'll keep thinking this is just sentiment. Now here's the conflict the mainstream story keeps smoothing over. They'll tell you a weak rupee means risk off, or. And risk off means people dump stuff and therefore metals should fall. That's a clean storyline. It's also incomplete, because in a currency-stressed environment, metals can trade like insurance, not like a trade. An insurance demand doesn't ask your opinion. It asks for a price. But there's a hidden detail here that reframes everything, and once you see it, you won't unsee it. The hidden detail is that the headline price is not the signal. The gap is the signal. The basis, the premium, the spread between what the paper market says and what the physical market can actually clear at locally. In other words, the metal is not just moving. The wiring between markets is straining. And that's when seemingly normal moves turn into step changes. If you want one mental image that actually fits, think of it like a bridge with traffic flowing smoothly until one lane gets blocked. The cars don't disappear. The demand across doesn't vanish. It compresses into fewer lanes, speeds change, tempers flare, and suddenly the whole system is behaving differently. That's what happens when FX stress hits a metal import pipeline and liquidity thins. The next detail is what flips the whole setup, because the dollar strength headline is not the real culprit. The real culprit is dollar scarcity at the wrong time. This week, right now, you're in a window where routine dollar demand can spike into something sharper. Month-end flows, balance sheet optics, corporate settlements, import payments, and banks managing their books. When you combine that with thinner liquidity, the market becomes jumpy. Spreads widen. Price gaps, everyone becomes more reactive. And that's when a move that should have taken weeks happens in days. But that's not the part that matters either. What matters is how metals respond first, not in the headline, in the structure. Look at silver as the first responder. Silver doesn't whisper, it screams. It's small enough to move violently, liquid enough to transmit stress, and industrial enough that you can't dismiss it as purely fear. When silver catches a bid during currency tension, it's often telling you that participants are hedging more than a price chart suggests. It's also telling you that volatility is about to rise, because silver loves to punish anyone who treats it like a slow, polite asset. And that's where the real pressure starts. Then look at copper and industrial metals, because they reveal the plumbing. Copper's not a religion, it's inventory math. If the nearby contract tightens versus the forward months, if cash prices spike relative to longer dated delivery, that's not mood. That's the market screaming that metal is needed now in the front end, and someone is willing to pay up to get it. Those spread moves can be early warnings that supply is tighter than people assumed, or that inventory is in the wrong places, or that financing and delivery constraints are forcing uncomfortable bids. But if this one level breaks, the math changes. Now fold that back into India, because India is where the translation becomes painfully real. A rupee slide doesn't just change your conversion rate, it changes your demand curve. Jewelry demand is sensitive to price shocks. Industrial procurement can pause, substitute, or hedge. Importers can delay shipments, reprice, or aggressively hedge FX to protect margins. And all of that behavior feeds back into the futures market and the physical premium structure. This is how the loop forms. FX stress raises replacement cost raises hedging demand raises pressure on currency markets and local metal pricing, and the sticker shock then changes real-world buying behavior. But that's not the part that matters. The part that matters is how the paper market tries to normalize this in the short run, and how the physical market refuses to cooperate. Let's talk about the paper versus physical tension in a way that actually makes sense. Futures markets are incredible at discovering price when the system is calm. They're also incredible at creating illusions when the system is stressed. Because futures represent claims on metal, not the metal itself, most contracts never end with a truck delivering bars to someone's door. They end with a position being closed, rolled, or cash settled. That's not a conspiracy. That's how the market is built. And when the rupee is collapsing, the most important question becomes, is the stress showing up in deliverable supply, or is it just speculative churn? That's why the hidden metric matters, the local premium and the basis. If local prices are running ahead of global benchmarks, if premiums stay elevated even when the dollar price pauses, it suggests the physical pipeline is tight or demand is inelastic or both. If the premium collapses while paper prices hold, it suggests the physical demand is backing off and the paper market may be running ahead of reality. That distinction decides whether you're looking at a squeeze-prone setup or fadeable spike. And the next detail is what flips the whole setup. Because FX stress also changes how options and hedging interact with metals. You don't need to be an options trader to understand this. You just need the basic mechanism. When volatility rises, dealers and hedgers adjust. If a lot of calls get bought in a rising market, dealers may hedge by buying futures as price rises, which can amplify the move. If a lot of puts get bought in a falling market, hedgers may sell into weakness, which can deepen drawdowns. That feedback loop is reflexive. It doesn't care about your macro thesis. It cares about positioning and risk management. And in metals, where liquidity can thin and moves can gap, these dynamics can turn a normal week into a week that feels like a month. So when you hear rupee collapse, don't just think India problem. Think volatility regime shift. Because currency stress can be the match and metals can be the tinder, especially when global investors are already uneasy about policy, inflation expectations, and the credibility of institutions. But that's not the part that matters. The part that matters is proof, not vibes, not doom, proof stacking. Proof point one is the simple translation effect. If USD-INR is pushing toward record territory around the 92 handle, every dollar-priced commodity imports higher in local terms even before anything else happens. That's not a forecast. That's arithmetic. If the rupee moves 1% weaker and your imported commodity price stays flat in dollars, the rupee price still rises about 1%. Then you add shipping, insurance, financing, duties, and dealer margins, and the retail impact can feel bigger than the FX move itself. And that's where the real pressure starts. Proof point two is calendar behavior. This isn't happening in a vacuum. End-of-month flows are notorious for distorting FX because participants need to settle accounts, manage books, and reduce visible risk. Liquidity often gets thinner. Bid-ask spreads widen. And the market becomes more jumpy. If you've ever seen a move accelerate for no reason, the reason is usually plumbing and timing. Weekends can do this too, by the way. Gap risk increases when markets are closed and news can hit. That's the why now trigger. It's not mystical, it's mechanical. Proof point three is what you can observe in metal market structure. Look for front-end stress. In metals, when nearby months trade stronger than deferred months, you're seeing urgency. Backwardation can be a sign of tight supply, strong immediate demand, or financing constraints. Contango can be normal in well-supplied markets, but when contango narrows abruptly or flips, it tells you something changed. Even if you don't trade spreads, you watch them because spreads are the truth serum. And the next detail is what flips the whole setup. Proof point four is institutional behavior. When funds and banks feel uncertainty, they don't always buy gold because they're scared. Sometimes they hedge currency. Sometimes they reduce exposure elsewhere and reallocate. Sometimes they buy optionality. Sometimes they buy duration. But in an environment where policy noise is high and confidence is fragile, gold and silver can become the default collateral of belief, not because they're perfect, but because they're globally priced, widely recognized, and liquid enough to move size. When that happens, flows can overwhelm micro fundamentals in the short run. That's why you need the basis and premium readout to stay honest. Proof point five is on-the-ground symptoms. When the rupee slides and local metal prices jump, you'll often hear the same phrases from dealers and buyers. Availability is tight. Premiums are up, People are waiting, imports are delayed, hedges are expensive, credit terms tightened. You don't need perfect numbers to respect those signals. You just need to recognize that when physical participants change behavior, the whole pricing machine changes. But that's not the part that matters. The part that matters is how this can break either way, violently, even if your thesis is right. Because here's the finance credible warning. Price can whip around like a weapon even when the underlying trend is intact. Metals and FX are famous for this. You can get a brutal pullback that looks like the thesis died, only for the market to rip to new highs a week later when hedging resumes, when options hedges flip, when month-end passes and positioning resets, or when some macro headline hits at a thin moment. That's why you need a psychology shield. And that's where the real pressure starts. So let's build that shield quickly without therapy language. The market will try to manipulate your time horizon. It will give you one huge green candle and make you feel late. Then it will give you one ugly red candle and make you feel stupid. Both are tricks. The question you ask is not, did it go up today? The question is, did the signal change? And the signal is not your feelings. The signal is structure. Structure means, does USD-INR keep making higher highs and higher lows? Or does it stabilize and start breaking down? Structure means, do local premiums stay elevated or do they collapse? Structure means, do spreads in metals stay tight in the front end or do they loosen? Structure means, does open interest and volume suggest forced liquidation or fresh demand? Structure means, do pullbacks get bought quickly or do they grind lower with no urgency? Because if the pullbacks become controlled and shallow, that suggests demand is lurking. If pullbacks become air pockets with weak bids, that suggests the move was froth. And the next detail is what flips the whole setup. Now let's translate all this into what it means for metals right now, this week, this month. In rupee terms, gold and silver can keep climbing even if the global dollar price pauses, because the rupee leg is doing the work. That's the two-speed market. Global investors might see gold stall. Local buyers might see gold surge. Both can be true. That split is exactly where traders get trapped. A trader watching only global charts might short a tired gold chart, then get steamrolled in local terms when the currency leg pushes the effective price higher. Conversely, a local buyer might chase a spike without checking whether premiums are blowing out due to temporary scarcity that could normalize. Both mistakes are common. Both are expensive. Now, where does dollar strength actually matter? It matters in the financing channel. If global funding tightens, if dollar funding becomes pricier, emerging market currencies often feel it. Even if a global dollar index looks sloppy, localized dollar demand can remain firm. That's why I keep saying the headline is not the signal. The mechanism is? Let's talk through the mechanism in plain terms. An importer needs to pay dollars to buy metal. If the rupee weakens, they need more rupees per dollar. If they don't hedge, their margin gets destroyed. So they hedge. Hedging usually means buying dollars forward, or buying a derivative that benefits if USD-INR rises, or buying metal futures as a proxy depending on their exposure. That hedging demand is not optional if they want to stay in business. So when the rupee starts sliding, hedging demand can increase into weakness. That demand can itself add pressure to USD-INR. That pushes the rupee lower. That raises the local metal price. That triggers more hedging. Loop. Now add the calendar trigger, month end. Banks manage risk. Balance sheets matter. Liquidity gets thinner. Suddenly, the same hedging flows move the market more than they should. That's why the move feels like it has a mind of its own. It doesn't. It has incentives and constraints. And that's where the real pressure starts. Now let's get specific about what to watch over the next week or two, because this is where you either become calm or you become exit liquidity. First, watch USD-INR around that recent extreme area near the 92 handle. You're not watching it to predict the exact top. You're watching it for behavior. Does it spike and instantly mean revert, suggesting supply of dollars shows up? Or does it consolidate near highs, suggesting the market is comfortable with a new regime? Consolidation near highs is often more bullish for the trend than a dramatic spike because it means the move is being absorbed instead of rejected. But that's not the part that matters. Second, watch gold in dollars relative to its recent breakout zone. If gold has been flirting with new record territory, you want to see if pullbacks hold above prior resistance. Breakouts that hold their retests tend to invite systematic buyers, trend followers, and risk parity style allocations. If gold breaks down hard below the breakout, it can trigger de-risking and create a nasty flush, even if the long-term story remains intact. This is why you separate trend from noise. One ugly day is not an invalidation. A structural break with follow-through might be, because if this one level breaks, the math changes. Third, watch silver's behavior on dips. Silver is your volatility barometer. If silver refuses to give back gains and starts making higher lows, it suggests persistent demand and a market that's willing to carry risk. If silver dumps sharply and can't recover, it often signals a broader risk-off move or a liquidation wave. Silver doesn't do gentle, it does messages. And that's where the real pressure starts. Fourth, watch copper spreads and inventory chatter, even if you're not a copper person. When industrial metal spreads get stressed, it means supply and demand are colliding in the front end. That can spill into the whole complex, especially if it hits the narrative that commodities are just speculation. Spreads are how you separate real tightness from a story, and the next detail is what flips the whole setup. Fifth, watch local premiums and the gap between local benchmark pricing and international benchmarks. If premiums stay firm, it suggests physical demand and/or supply friction remains. If premiums collapse while futures prices remain high, you may be seeing demand destruction or normalization of supply. That doesn't automatically mean metals crash. It means the nature of the move changes. And if you're not watching this, you're trading blind. Now, because you're a finance-minded viewer and not just here for drama, you also need counterpoints, real ones, because markets punish certainty. Counterpoint 1. Rupee weakness can prompt policy response or intervention that stabilizes FX, at least temporarily. Even verbal guidance can change behavior. If that happens, local metal prices can cool fast, not because gold failed, but because the translation leg stopped accelerating. Counterpoint 2. Demand destruction is real. If local prices rise too fast, buyers step back. Jewelry demand can pause. Industrial buyers can delay orders. That can pressure local premiums and reduce the immediate bid. Counterpoint 3. Global risk sentiment can shift. If global markets suddenly move into a liquidation regime, metals can get sold as a source of liquidity, even if they're a safe haven in theory. In the short run, correlations can go ugly. That's not a betrayal. That's margin math. And that's where the real pressure starts. Counterpoint 4. If real yields rise meaningfully, or if the market reprices rate expectations aggressively, that can weigh on precious metals in dollar terms. Again, not forever, but enough to create a drawdown that tests conviction. So you don't need a single heroic prediction. You need a two-scenario lens that keeps you sane. Scenario 1 is the controlled pullback and retest. In this scenario, USD-INR stabilizes or backs off a bit from extremes, month-end pressure fades, and metals cool in rupee terms, maybe even pull back sharply for a few sessions. The key is that it's controlled. Dips get bought, premiums don't collapse, spreads don't scream all clear. If that happens, the pullback is not the end of the story. It's the market resetting the spring. Confirmation looks like higher lows in silver, gold holding its breakout zone, and USD-INR failing to push to fresh highs. Weakening looks like premiums collapsing and metals failing to bounce on obvious support. Scenario 2 is the continuation squeeze with gap risk. In this scenario, USD's INR either breaks to fresh highs or consolidates near highs without relief, and metals keep repricing in local terms. Premiums stay firm, front-end spreads stay tight, options hedging amplifies moves. You get sharp up days, then small pullbacks, then another rip. The danger here is not just price, it's psychology. You'll feel late, then you'll feel scared, and the market will try to make you trade your emotions. Confirmation looks like the rupee failing to recover on good news, metals refusing to give back gains, and physical tightness signals persisting. Invalidation looks like a decisive rupee reversal paired with collapsing premiums and spreads loosening. Now, let's talk about levels in a way that's useful without pretending I can see the future. On the FX side, the obvious zone is that recent recordish region around 92 to the dollar. If USD-INR holds above prior breakout levels and keeps printing higher lows, that maintains pressure on local metal pricing. If it breaks down and starts living below those levels, the translation pressure eases, and metals in rupee terms can cool even if global gold remains firm. On gold, the key idea is the breakout structure. If gold has recently been near all-time highs in dollars, the market will care about whether it holds the last consolidation zone beneath those highs. Breakout, retest, hold. That's the anatomy of a trend that survives volatility. If it loses that zone and can't reclaim it quickly, you can get a nasty downdraft that feels like the thesis died. But that's not the part that matters. What matters is whether the structural demand returns on the next test. On silver, you watch the last swing low on the daily structure and how it reacts to pullbacks. Silver that holds higher lows tends to drag the complex higher. Silver that breaks structure tends to lead to surprise drawdowns across metals because it's the margin call metal. It moves fast and it forces decisions. And here's the practical take. Even if you're bullish metals, you don't need to worship every candle. You need to respect volatility. Metals can gap, FX can gap, weekends can punish you. That's not fear-mongering, that's market structure. And this is the moment where the market will try to use volatility against you. Here's how it does it. It will show you a giant move and make you think the opportunity is gone. Then it will dump the price quickly and make you think you were wrong for even paying attention. Then it will bounce hard without you. The goal is not to beat you. The goal is to transfer risk from strong hands to weak hands. The way you resist is by predefining what would actually change your view, not what would scare you, what would invalidate the mechanism. So what invalidates the mechanism we've been talking about? A clear, sustained stabilization or reversal in USD-INR combined with collapsing physical premiums and easing front-end spread stress. That combination says the translation pressure has eased and the physical tightness, if any, is dissipating. What strengthens the mechanism? USD-INR holding near highs, premiums staying firm, and pullbacks in metals being bought quickly, especially if the market is entering a calendar window that tends to amplify flows, like month-end and option-related events. Because if this one level breaks, the math changes. Now, one more layer that finance skeptics will appreciate. Institutions don't need to believe in gold to buy gold. They just need to manage risk. In a world where policy messaging can flip, where inflation expectations can reprice, and where currencies can move in uncomfortable bursts, gold and silver become tools. Tools for hedging, tools for diversification, tools for signaling. That doesn't mean they go up in a straight line. It means demand can appear with less warning than people expect. And that's where the real pressure starts. So where does this leave you? Right now, today, it leaves you with a checklist, not a prophecy. Watch USD-INR behavior around its recent extreme zone. Watch whether gold's dollar breakout structure holds on retests. Watch silver's dips for higher low behavior. Watch copper and industrial spreads for front-end tightness signals. Watch local premiums and the basis gap as the hidden truth meter. That's 5 proof channels. If 3 or 4 are aligned, the setup is strong. If they fracture, you reduce conviction and widen your scenario lens. And please hear this part. You can be right on the thesis and still have your timing punished. That's normal. That's the cost of trading and investing in markets where leverage and hedging exist. Your job is not to avoid volatility. Your job is to avoid making volatility your decision maker. One last thing, because this is the part that separates the retail crowd from the people who survive long enough to compound. Don't confuse institutional incentives with cartoon manipulation. Markets do have power dynamics. They do have players with different constraints. Banks manage risk. Funds manage flows. Dealers hedge options. Importers hedge invoices. None of that requires a secret meeting in a dark room. It's just incentives. And when incentives collide with thin liquidity, you get violent price discovery. That's the real story. If you're still with me, here's your near-term roadmap in one breath. If the rupee keeps failing to recover and holds near recent lows, metals in rupee terms remain under upward pressure. If metals pull back but premiums and spreads stay firm, that's often a reset, not a reversal. If premiums collapse and spreads ease while USD-INR stabilizes, the translation-driven spike can cool fast. And in both cases, expect whipsaws, because the market will try to force you into emotional trades. Don't let it. Define your invalidation. Watch the hidden metric. And stay focused on what participants are forced to do, not what commentators are paid to say. And if you want to be part of the small slice of this audience that doesn't get emotionally rented out by volatility, stick around for the next one. Because we're going to track that basis gap and those spreads in real time and talk about what it usually means when they diverge from the headline price. That's the edge. That's the community. And that's how you stop being surprised.